Hello, everyone, and welcome to the Retirement Planners of America podcast. I'm so glad you are with us. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and we have a lot to talk about. The interesting thing about how fast things are changing is that, the next thing kind of replaces the previous thing so quickly that you almost forget the previous thing even happened. And so, but a lot has happened over the last week. We want to cover it all for you and give you some ideas of where we think this is going to take the market, which is the most important thing to us, of course, our investments. And as you may know, I am the founder and CEO of Retirement Planners of America, and therefore, this video is designed for those of you who are over 50, who are retired or retiring soon. We're going to be talking in the context of if you're that investor, if you're within 5 years of your retirement or you're already retired, how does all this impact you? What should you be doing about it? So that's where we sit. So thanks for watching. And as always, I hope this podcast finds you healthy, wealthy, and wise. I want to introduce or bring back with me Jordan Roach, my Chief Investment Officer. And so we're going to discuss all this stuff. So let's start off with Walmart. Very interesting. Yesterday they came out and said that they're anticipating they're going to have to raise prices, potentially even have empty shelves, which, we're so used to. You walk into Walmart and it's packed with everything. And the potential that that's not the case potentially could be pretty scary, right?
Yeah, Walmart is a huge data point that the market's going to digest on how it's going to affect consumers. On the whole, it's going to be price-focused, price-sensitive consumers.
Right.
Walmart is a huge supplier and seller of all sorts of diversified goods, from groceries to apparel to all these things that we get pretty much from everywhere except here. And so the market's certainly looking for them to see what's going to happen. And I think, for the first time, we're starting to see forward guidance. Because for a while, companies just went on lockdown and said,
true.
I don't know. I know nothing about nothing. Don't
true.
ask me. And to see Walmart come out and say, we think it's not only saying what's going to happen, but it's start a timeline on it.
And not only that, but Walmart gives cover to everybody else. In other words, if Walmart says we're going to be raising prices,
that's right.
Then everybody else goes, oh, okay, well, then we
Costco
can too.
and Target and you get to follow
Right.
next, and everybody else.
Yeah. So they want to keep that gap, right?
That's right.
So so that's very interesting. At the same time, we had 2 weeks ago or so, or a month ago, we had very robust retail sales, right?
Yeah.
So the consumer was being surveyed, and they're saying, we feel terrible. We're worried about tariffs. We're worried about price increases, but yet we're going to go shop.
That's
and
right.
now we just got the retail sales numbers, and they were sharply lower. Mm-hmm. So maybe the way they were feeling told us something about their behavior, and today, give us some insight into what you think about that.
I think that's exactly right. I think there was so much uncertainty, but there was no actual data suggesting inflation's going up, prices are going up yet. So I think consumers were front-running a lot of that. Companies were front-running, buying goods ahead of time to stock, to get ready to set prices because that would still find the equilibrium with consumers wanting to spend. And so that was happening over the last month. And it looked like, okay, the things that the Fed is considering to make their decision, which is effectively inflation and growth, the growth side, based on spending, is like, I think we're still okay. And now this is coming back through going,
like, oops.
Wait, well, I don't know. Yeah, that's right.
So maybe reality is setting in, right?
Yeah.
Maybe we had an illusion because people were stocking up, they were pre-buying, and that gave a boost to everything, made everything look good. And now maybe reality is setting in because that inventory could be depleted. And there was an interview that I saw with the guy that runs the Los Angeles Port Authority. And he was saying that 65% of all the shipping that normally comes into LA from China is still over in China. And he said at a minimum it takes 2 weeks to get over here. So if the negotiations with China take too long, that could have an adverse impact.
Yeah, that's going to be interesting to see because I think it was this week where we've had the first ship in like a month actually land. So one has, but the rest of them are still there. And in the back and forth with I guess it was Treasury Secretary from our side. I don't know who from China was coming into Geneva over the weekend to start talking a deal. I don't know who's there on that side. But it looked like, we're bringing tariffs down from 145 down to like 30, which is still higher than the base level of 10 to 20. So it's like, he's doing that jockeying.
Yeah.
China brought their tariffs back down on us to like 10%. So you'd think that in theory, in that world, the market was already pricing ahead of April 2nd. Maybe we can still exchange commerce, but maybe not.
Yeah, and reality has not set in. Right now, everything is just conjecture. What's going to happen? Will we have inflation? Will prices go up? Will they not? All this stuff. Will the negotiations, end the whole thing and it'll all be over or not? We don't know all that. The one thing that I find, I don't know if comical is the right word, but it makes me kind of chuckle, is if Trump had started off with, on Liberation Day, 30% on China, the market would have gone down like crazy.
Yeah.
But now he announces 30% on China from 145, and the market goes up 3% on that.
It's amazing. And 30 is still higher than what happened in 18 when we went through this the first time. Exactly. It's higher than the baseline.
So these are the highest tariffs we've ever had on China, and we're celebrating it.
But the market's rallying.
So maybe there is something to the art of the deal.
Maybe there is.
So one of the things that I saw an interview with Ken Griffin at
Citadel.
And he's they're a legendary investment house and one of the largest in the world. And in the interview on Bloomberg that I saw, he was talking about how if he had known back before Liberation Day what he knows now, he would have gone to cash, even though he has the benefit of having seen the market come all the way back.
That's interesting.
So he said, and they were very aggressive. He said, we're aggressive. We're always on offense and all of that. But despite that philosophy, I thought it was very interesting that he would say, if I could go back and rewind the clock and go back then, we would have gone to cash.
That's interesting from him. I mean, they're pretty full tilt most of the time.
Yes.
I mean, even through 08, I believe they changed a little bit, but they're still riding through most of those. So for him to say we were flying a little too close to the sun there, that probably wasn't a good thing. That does speak a lot.
Yeah.
Because the other thing about him too is Citadel has their hedge fund business, so they're running their own capital and clients' capital. The other side of their business is they actually are like the biggest market maker in the world. So they're seeing client orders, and most time when people are submitting orders, like 80% of the time, Citadel is the one that takes it, does something, and then turns it the other side. So they could take it not only with running their own money, but looking at what flow is going, saying this was way off.
Yeah.
So that's interesting.
Yeah, it is. And it, for me, validates what we did, right? Because we actually did what he's saying he would have done had he had the benefit, if he could go back to the future or back to the past, that he would have done that. And we actually did do it without the benefit of that hindsight.
We did not have the benefit. And at the time, we had clients, we didn't have prospective clients saying, this is all event driven, this is all going to sure up really, really quick. Y'all are crazy, don't do anything there, which is all just emotion and thinking. And for the guy that, controls a wild amount of money and data flow to say, no, this was a bad decision from our part.
Despite the positive outcome. Let's talk about that in the context of someone who is within 5 years of their retirement or in the first 5 years of their retirement.
Okay.
Because philosophically, we believe that decade is the single most important decade of your entire financial life. Because no matter how well you have done, leading up to that, you may have been the most successful investor in the history of the world. You take a 50, 60% drop in your investments during that decade,
sure,
you may not be able to retire, or you may not be able to enjoy the lifestyle you wanted to have during your retirement, both of which are not good, both of which we do not want for our clients. So that's why our bias is growth is important, but protection of principal is even more important.
Yes.
So going defensive, give us some context on why our philosophy for someone who's in that decade is different than if they were 30 or 40 years old.
Well, it's a couple things. One is, depending on the duration and magnitude of the decline. So magnitude is how much you lose. Duration is how long does it take you to lose that much money, and then how long it takes to get it back.
How long it takes to get it back is massive.
It's massive. So, if you take some of these big bad bear markets we've seen, and it's hard to know, we continue to try to prove our process to distinguish between we think it's a bear versus a really big bad bear, and it's hard to get that right. But you think the bad ones, and again, there's been a handful of really bad 40-plus percenters, typically those take 1.5 to 3 years from top to bottom. That's this grinding 48 percenter. So not only are you in a state of loss for a long, long time, well, if you lose 50%, now I got to double it on my gains to get it even back to neutral.
And you can't be taking any money out during that time. Because to get back to neutral implies that you didn't touch it.
That's right.
Because if you're taking it out, you're doing what farmers call eating your seed corn.
That's right.
And if you eat enough of your seed corn, growth season comes, you ain't got nothing left to plant.
And what we find, and this is why we kind of systematize our risk management framework, is if you look at some of the biggest inflows into the market and outflows, it's at the exactly wrong times. Meaning, in '07, certainly in 2000, those are two of the biggest periods for inflows into the stock market in history, which are literally at the peaks. And if you look at two of the biggest periods for outflows, most outflows are not happening in the first 5, 10, 15%. No, it's once the market's down 30, 40, 50, that's when people say, I'm done.
I can't take it anymore.
Which is the worst part to do it. Right?
Yeah.
By then, it's like, you're closer to the bottom than not.
Yeah.
And so we just have to try to make a framework to have a consistent decision-making process to where it keeps us out of the emotions, because there's plenty of that to digest.
Yeah, it's easy to chase returns or to panic when the market is dropping like a stone.
It's natural.
And having a disciplined approach and actually having a plan in advance.
Yep.
You don't want to be reacting to a tornado when it's upon you or a hurricane. You want to have a plan to address it. And, especially, one of the questions that we ask people in our seminars is, between now and the rest of your life, what do you think the odds are of having a big bad bear?
What's the average? I hope people give a pretty high probability on that.
It's usually 100%.
Because I'm thinking people in the last 15 years forget what bear means.
Well, that's true. Yeah,
But
2008 was a while back, so memories have faded.
Yeah.
And people think those can't happen again. So let's also talk about the yield curve.
Okay.
And where we sit right now in terms of our posture. Defensive versus offensive. As we sit right now, we're still in a defensive posture.
Right.
And we did so because not only did our strategy, our invest and protect strategy, say, time to get out, but the yield curve also said a recession coming.
Yep.
And the yield curve has predicted every single bear market we've ever had. So it's a very reliable indicator.
Yes.
Right. So tell us, where we are. What is the yield curve first, for those who aren't familiar? And then secondly, what does the yield curve do when we have a bear market that is attached to a yield curve inversion?
Yeah, so first of all, the yield curve, how we look at it is, we use the stock market, technical signals to tell us what we think the stock market's doing, and that's nice and reliable. We use the yield curve to tell us what's the other side of the market telling us, the bond market. And it's basically looking at the relationship between short-term interest rates, which kind of have a basis based on what the Fed is doing, but short-term interest rates move up and down because the market's setting them based on expectations, and longer-term interest rates. And what you're looking for in a healthy environment is short-term rates should be lower than long-term rates.
And that would be because the Fed wants to slow the economy down because it's doing so well, so they want to raise interest rates in the future. But the reverse is also true, right?
The reverse is
if
true.
They're viewing that there's a recession coming, then interest rates will be lower in the future, presumably.
That's right.
And so when the yield curve is inverted, meaning long-term rates are lower than current rates,
Yes.
that generally forecasts a recession coming.
That's right.
And when we've had a bear market with that inverted yield curve, what has been the result in most cases?
I mean, if you go back to the early 1900s, because prior to then, how interest rates work is completely different than how they exist today, because the Fed wasn't even in existence. But of all the big bad ones, the yield curve basically forecasted that was coming well before the stock market even saw it coming. And on average, when the yield curve inverts, and then you look at bear markets, so 20+% declines or more, on average, the market's down over 30% when the yield curve sees it coming. Mm-hmm. Now, there's all types of yield curves, and there's certain ways we look at it and certain types. But the yield curve is very good because it usually is far ahead of the stock market in terms of predicting pain. Yeah. It's more of a macroeconomic indicator versus the stock market, which takes into account individual companies, psychological things, all those.
Yeah.
So it's a nice complement.
Yeah, and the interesting difference between stock market investors and bond market is that stock market investors, to a great degree, invest because they're in love. They're in love with NVIDIA. They're in love with Tesla. They're in love with whatever the thing is of the day, and they plow money into it because they're in love. Mm-hmm. And love is a very strong emotion, and that can turn to fear. It can turn on a dime. The bond market is lending people money.
Yes.
So when you're lending people money, you're not doing that on emotion.
That's right.
Right? You're now looking at their balance sheet. You're looking at their ability to pay. So you're making some very rational decisions because you're lending this
right.
person, this government, this company, you're lending them money.
Yes.
So in a lot of cases, most cases actually, I would say, the bond market is far more rational than the stock market is.
I think that's right. I mean, and big moves in the yield curve are far less likely to be seen in any given year than the stock market is to go down 5 or 10%, which happens basically every year. That's right. So the yield curve for us is an important kind of, we've termed it sanity check to what our stock market signals are telling us, determine what do we want to do.
Yeah, and just to be clear, it's one of 4.
That's right.
But it's a very important one.
It's a very one.
And so back when our strategy said to sell, our investment protect strategy said to sell, we also looked at what's the yield curve doing. It's inverted, and therefore we had strong conviction that we needed to take evasive action.
That's right.
And so that's what we did.
Right. When those things, are basically telling us the same thing, because any given point they could tell us different things. But when they converge, that gives us a very strong conviction that we need to take some sort of preemptive action.
Yeah. And, we believe that growth is important, but protection of principal is even more important. Or said another way, it's better safe than sorry. And
absolutely.
And there's a thing called opportunity cost. Right? Which means that if you get out, as we did with half of our equity position, you could miss out on the rebound when it comes. That's opportunity cost. You could have made more had you not done that.
That's right.
But for our clientele, people who are over 50, retired or retiring soon, they're willing to give up some of that upside in exchange for protection against the downside. Because at this stage of your life, big losses are potentially the biggest enemy you have.
That's exactly right. I mean, for us, the biggest thing that damages clients is going to be those long-term downtrends that we're hoping to identify and keep them out of. In the same way, we can forego a little bit of opportunity cost short-term because by the time we get in, we're trying to capture the longer uptrend, not the shorter-term moves. And so we're willing at certain points, certain cycles, to give up a little bit of those in-betweeners to catch the broader moves and to have a safer journey on the growth spectrum.
Yeah, and as we were talking about before, when you're taking money out to live on, if you are retired and you're using that, which most of our clients do, then you don't want wide swings in the market, big drops, because the farther down it goes, the more shares you have to sell of your investments to get the same dollar amount. And the fewer shares you have, the less you have when the rebound comes.
Yes.
So for a lot of reasons, we believe that having a strategy to protect against these big bad downs is important, and sometimes it does come with that opportunity cost. That's just a fact.
And it does, and the thing that's hardest about bear markets or just initial sell-offs, whether they're short-term, they're long-term, is knowing, when the market tries to recover inside of a downtrend, is the recovery real or not? So, I know we were looking, with our investment committee of, are there defined entry points we could have been made in the last month? But nothing's definitive outside of just saying, well, we think this event-driven deal is going to cause everything to go up. That's a bet. One thing I was looking at last night studying was looking back at Y2K, just because there's some thematic stuff that's similar to this cycle in terms of AI technology-driven stuff. Valuations are high after a really good decade, those things. And the scary part of that Y2K, which was a 49%er, on large cap, big U.S., 80% on the NASDAQ.
And a 2.5 year.
2.5 years, right? I mean, there's a lot of stuff going in there. A lot of pain there. Inside of a 50%er, you had I think you had 10 or 11, at least 5% or more recoveries inside of a 50%er. So you had a lot of people chasing all these mini recoveries that ended up being head fakes. And so that's why we are sometimes a little bit more patient on the buy side, because a head fake it can be painful.
Yeah. So, as we always say, we want to do the worrying for you so that you don't have to. Let us get the gray hair. You're getting a few gray hairs there too,
gray hair
Jordan.
And gray beard. We're getting there day by day. That's right.
And so thank you for watching this episode of the Retirement Planners of America podcast. I hope that it gave you some insight into how we think. And again, our way of looking at the world is different than maybe most, because we're looking at it from the standpoint of that, that most important decade, the 5 years before you retire, the 5 years after. And so when you're in that decade, the way you think, we believe, should be different. You know, it's like the coach of a football team. You got your offensive coordinator, you got a defensive coordinator. In our view, once you get into that decade, you can't be the offensive coordinator anymore. You're now the defensive coordinator. You want to keep the other team from scoring. You don't want inflation to reduce. You don't want taxes to reduce. You don't want bear markets to reduce. You want to make sure your cost of living is in line, because that could score on you if you follow that allegory. So there's a lot of enemies to your financial well-being once you get into that decade that you didn't have when you were 20 or 30. And thinking differently, I hope this podcast helped you to get a little bit of that into your mind. So thanks for watching. Please like and subscribe to this podcast. It helps us a lot, and also it'll help you, because as I always say, you miss our podcast at your own peril. So thanks for watching. Hope this found you healthy, wealthy, and wise, and we'll talk soon.
Retirement Planners of America.